Hello and welcome to the Harwood Report for October 15th, 2017, presented by Trade Academy. I am your host, Keith Harwood, the founder of Trade Academy. So as we start with the disclosures, all services and content provided here are for educational and information purposes only and are not intended as legal or financial advice. Please read the other disclosures. The main point is all of these trades that I'm looking at are trades that I am considering for myself. They are not a recommendation for you. Do your own due diligence before entering into any trade. So this week, we're going to do the normal stuff where I go through the macro indices, S&Ps, NASDAQ, small caps, and Dow Jones. I'm going to look a lot at the rates, Forex, and commodities again. Dollar went a little differently than I expected last week, so we're looking at that again, figuring out what I expect to see happen next, and how that impacts gold, treasuries. Take a little look at oil just because it had a good move, but I don't actually see anything great for me to trade in the energy ETFs. That said, I still think oil is important just as a note, and it has a potential impact on things like EWZ, which is why I'm going to look there, and XME. I'm going to take a look there. I know metals and oil aren't 100% correlated, but they are something to look at together. And of course, the financials, which also come back to dollars and rates and all of this other stuff. So there's a lot here. I want to start as usual with fear and greed. I talked before about fear and greed being really high. It was, I believe, 92 a week ago, close to 95. It's come down without the market breaking. What that means is moving averages are catching up. There's some sector rotation happening. Things are happening in the market that make this overbought level not so frothy. It can happen by correcting in time instead of in price. Correcting in time means that the market stays relatively stable, and then all of those moving averages and everything else kind of catch up to the point where the market's not incredibly higher than you would expect, or than we would expect. So that's why fear and greed is dropping without the market dropping. Doesn't mean that people aren't very long. It doesn't mean anything necessarily. It just means consolidation is happening, and I can't look at fear and greed as a really big flag for a reason why the market can't go higher. The market can possibly go a little bit higher now. I expect normally to see fear and greed come back closer to 50 before we get another leg up, but that doesn't mean it won't happen sooner. Just traditionally, that's kind of what I've seen for me. So I'm not necessarily looking at being extremely bullish on the market. I'm looking at sector rotation. So we'll start with S&Ps. As I said, I'm not an overly bullish. I expect the S&Ps to be a little bit higher. I mean, you can see here we're trading, just grinding a little bit higher while the moving averages catch up. And that's what I will be planning for overall, is a lightly bullish market with sector rotation. So S&Ps aren't going to be a trade for me, but it is important for me to know that I am still overall bullish on the market, and I don't expect to see a big washout in the S&Ps. Where I could see some sector rotation actually is in the NASDAQ. So NASDAQ had a little bit more of a pullback there in September and is still playing catch up to the move that we saw in small caps, for example. And on Friday, NASDAQ closed near its highs. It continues to have a little bit more money flow into it, and I think that it's getting a little bit more chatter in things like semiconductor names and the FANG names for some support to tech sector. So I think the tech sector has a little bit of potential if I were to look for a sector to see rotation into. I'm not going to focus any trades today on the Qs, but it is a sector that I think could benefit from money rotating. IWM, on the other hand, seems to be the weakest link right now. I mean, it had the biggest run. A strong dollar is not usually very good for, a weak dollar is not normally good for small caps. And so since the dollar has started to pull back, it looks like some of that money may be rotating out of small caps. With this in mind, I wouldn't be surprised to see small caps test the 20-day moving average. The 20-day moving average is rising rapidly, so for it to test, that can either be more chop or a little pullback. It doesn't have to crash down here to, quote unquote, crash down here to 147.5 to test the 20-day moving average. As you can see, if you go back a day, the 20-day moving average was 147.14. And now 147.48. So the 20-day moving average is rising 40 cents a day, or 30 to 40 cents a day. that test seems logical before I can really make a strong determination that IWM has to go higher. And since I mentioned the dollar was weak last week, and I actually expect it to continue to be weak, I'm not looking for IWM to have a rally this week. I'm thinking small caps have a better chance of getting a bigger pullback. So I am not a small cap bull. I think this fits with my sector rotation thesis, where I could see money coming out of small caps and going back into tech, especially given the run that IWM has had. Finally, the Dow Jones Industrial Average. This has been that grind higher, a little bit stronger than the S&Ps, but not nearly as crazy as IWM. And I just think that this is going to be a grind higher as well. This is simple. There's not much to this. It is grinding higher until I start to see a bigger range, at least. I can't really justify any sort of short position in Dow Jones Industrial Average. That's setting, a small long, maybe for a grind higher, but not a big optionalized long. So overall, these markets on the whole seem very grind higher with sector rotation. So that's S&P's grind higher, Dow Jones for me, I expect to grind higher. And I kind of see this idea of a rotation of money into tech and out of small caps as a logical thing to look for. And so I'll probably look for stuff in individual names for that as a way to trade it. But right now, there's no trade for me in the names that way. Where I see the best opportunity for my trading style is actually going into the dollar. So last week, dollar yen closed just above the 10-day moving average over the course of the week, faded below the 10-day moving average into that zone where I tend to get neutral on the dollar yen and also neutral on things like TLT and GLD and whatnot. So here on Wednesday was the Fed minutes. I originally expected that to be firm for the dollar. It didn't have any sort of firmness to it. It kind of told me that day that more than likely the next move is going to be lower on the dollar. And then CPI was the confirming piece of news that people needed to put a little bit of pressure onto the dollar yen. Closed on the 200-day moving average. This is going to be, it's kind of a logical spot for it to stop temporarily, but I don't see the 200-day moving average generally providing much support. Other times when we've kind of flipped, 200-day moving average was no real support here. It took 1 or 2 days before the big break. Here the 200-day moving average, it's only a couple of days before the break really happens through there, and you could argue that the last few days have all been testing the 200-day moving average just because all these moving averages are so tight. So I'm not looking at the 200-day moving average as a big place of support for dollar yen here, and MACD is weak. There's a lot of reasons now that I'm thinking dollar is going to continue its weakness against the yen, and that's good for gold. I was in the camp last week of being a little bit bearish gold, expecting to see this be the retest of the 100-day moving average before it pushed down to the 200-day moving average. Well, instead, there was some good bullish action, and then Friday's CPI data really helped pull gold up. If I look at this chart, everything I had been looking at in gold and precious metals was all puts for obvious defined risk reasons, but also cheap leverage. Everything looks bullish now, and I think switching into some long calls is going to make sense for me. In GLD, I don't necessarily want to be long options, though, and I'll show you why. If we look at the chart of gold, volatility is still lower than it will be if the market rallies back to new highs of 13-ish%, but it's still not that cheap compared to some of the other products. So I'm going to go over to one of those right now. This is going to be our first spot where I think there might be an interesting trade for me on Monday. And that's GDXJ. So the gold miners, the junior gold miners often lag. It happened throughout most of the year where the junior gold miners lagged and then finally had a big rip in the beginning of September. That really kind of coincided with the last turn in gold where gold miners were the last to move. Sorry, the junior gold miners were the last to move, and that signified sort of the top in gold for then. Well, gold miners continued to lag last week even. Friday's close, not this past Friday, the previous Friday's close was 34.59, and this past Friday's close was 34.62. So junior gold miners didn't move at all week. GDX rallied a little bit, still underperforming there, and silver, of course, one of the best performers on the week. Usually silver bullishness correlates really strongly to the miners. So this is a little bit of a surprise to me. I think GDXJ has some catch up to do. And so given that I think GDXJ has some catch up to do, and when I look at volatility, I see GDXJ, incredibly cheap volatility. This has been something I've been noting for a while, and it continues to grind lower because the market's not exploding higher, but we're 27%. And if you look over the last year, at the beginning of the year, end of last year, volatility was around 55% in this index, and at the beginning of this year, it was closer to 46%, and now it's at 27%. This is just really, really cheap options. Excuse me. So I think that there's something here, and with vol this low, I am going to add some timed expiration. You see these first 2 months look really cheap, but once you actually take out the weekend decay, that's going to go towards 26-27% if prices stay the same. It'll probably come in around 24%. And the 27th really looks closer to 26-27%. November 3rd, we're talking 27 to 28%. That's still very cheap. I like giving myself a little bit of time in case GDXJ continues to lag for another week. And so where I'm looking at a play for me is going to be on these November 3rd $36 calls. Sorry. Yeah, November 3rd $36 calls. That's right. I'm looking at those around 38 cents with the lag and that potential catch up. If we look at the GLD chart again, so gold, if it makes that same kind of run, 126, 127 range, that's a pretty good run there, and GDXJ would be looking at something around 37 bucks in that case. So it didn't have as big of a pullback as gold. It's also been a little lagger on the rally, which is why this volatility got really cheap, because realized volatility was lower. But I think that if we get that move towards 37 in the short term with the potential for that breakout and move towards 42 in February. Remember where gold was in February last year, or this past year, was lower than where it's at right now. It was 118, 119 range. And the junior gold miners, at that point, we're trading around 41. If we look for that kind of magnitude of a turnaround, which I'm not necessarily planning for that right now, I'll let the markets tell me when this move is getting close to being over. But I mean, it just gives me some perspective on what kind of volatility I could potentially see in the junior gold miners. You see these kind of moves like the February 6th rally or the March 15th rally. I've seen some big volatile days, particularly coming out of consolidation periods, and I wouldn't be surprised to see some of that coming in now if commodities on the whole are going to get some money flow. So that's my my look there for GDXJ, is looking at these November 3rd $36 calls around 38 cents. The next one I want to look at is TLT. First, I'll just show you guys the 10-year yields, because that's really what TLT is based off of. TLT is the ETF, but the 10-year yields are obviously the input for TLT. So let me just pull that up. It's not wanting to pull up at first. Oh, I see the issue. Okay, so when I look at this, obviously CPI was the big knock on yields. It looks a lot like dollar yen, except for it's already below the 200-day moving average. That's crucial. There's not a lot of support here, maybe down to the levels of late September would be the initial support level that I might be a little worried about, which also coincides here with the, this is the 50 and the 100-day moving average here. So TLT, it's going to look very similar in terms of the chart, but this is going to be an inverse, view of that chart. So it's a bullish setup I'm looking at here. Potential move up at least to this kind of 128 range. The late September levels was around 127, but I think I'm looking for a 128, maybe 129 move over a little bit of time. There's not a lot of trade here before you get to 127. So 127 would be kind of a launching point for me, potentially. I wouldn't be surprised to see a little bit of a move up here into that 126, 127 range, and then the launch. And so if I'm looking for that to happen that way, the vol in TLT is near lows, but not at lows, but very close here. And I'm not looking for this to happen this week because of that little bit of consolidation here potentially in this 126.5, 127 range. So instead, I'm going to look at the October 27th, 127 calls. These are about 47 cents. Saw a little bit of bullish flow into TLT options on Friday. the biggest trade was in the front month was really this strike. Traded large size there for 11 cents, 6,000 times at 230. So it looks like a buyer to me with a bunch of stuff maybe trading at the money where maybe it could have been rolls, people getting rid of some stuff here at the money and then getting a little bit more of a wingy upside, or even just closing that open interest out. Whatever it is, I'm thinking right now that this is going to be a little bit of a grind higher for the week, and then a good potential for a bigger move the following week once the market consolidates and digests some of that move higher. So that's my second idea that I'm really looking at here at TLT is these October 27th, 127 calls. That's the main stuff from the dollar impact. I want to look at oil just because of what it did last week. Friday closed right here at $10 USO, opened up Monday at $10 and then started to go. Some of this is OPEC, some of this is decertifying Iran. Generally speaking, oil looks really good here, and in particular, when I run through DBC, this is just the simple commodity tracking index, so it's all commodities. Commodities are getting money flow here. See DBC. If I go to DBA, that's the ags, it's getting money flow. DBB, oh look, it's getting money flow. So commodities on the whole are getting some money flow. That creates an interesting scenario for XME. So I'm going to look at that first. I think the order I had on here was actually to look at EWZ first, but I'm going to start with XME. XME had a nice rally on Friday. Obviously, this is CPI driven, but we've got some real strength starting to show up in XME. Had a nice run in August, a little bit of chop here. Say that this may be a bull pennant here before the breakout. Now it's testing the recent highs here. The highs really, I don't want to see that there. There we go. The real high that I'm looking at is if I take out the wicks, the high is around $33, including the wicks. It's around 30. What's that? 33.43. So it's really testing these levels. Looks potentially good for a move all the way up to 35 here if this commodity flow story is really happening. When I look at XME, volatility is not all that expensive. In fact, it's cheap. Sub 20% is really cheap in XME. Again, I go out a year. This is an index that normally traded around 35% volatility. Commodity volatility on the whole has gotten crushed, mostly into the producers, the miners. XME is metal and mining ETF, so handle some of the base metals. So let's go back to the options now and see what else I think might be interesting from these options. There's a little bit here to note. If I go to November 3rd, which is one of the terms I like just because it has the next non-farm payrolls. Some good volume here on the November 3rd, 33.5 calls. Paper looks to have been buying them for 39.40 cents. That's a big order flow. That's big bullish money for this ETF. Some of the stuff for October 20th, we had a little bit of buying. It looks like in the 33.5 and 34s for next week. This trade I actually like is exactly what paper did here. These 35 delta calls here on the 33.5s. I'll try to work something mid-market probably and look to buy something for 36 or 37 cents on these no third 33.5s. And given the fact that somebody's starting to build up some positions here on the bull side, I like that that potential for XME. It means that somebody's starting to pay a little more attention, increasing the amount of money that they're allocating to metals and miners. So that's a sector I'm kind of excited by because of the commodity flow in general, and then that goes hand in hand with that weak dollar and those lowering yields and everything else. It's a bullish input for commodities on the whole. So I like this XME play for me. November 3rd, 33.5 calls. Just look really good today. Another way to play these commodities is actually in EWZ. So EWZ is the Brazilian ETF. Brazil tends to perform well when commodities perform well. Brazil produces a number of soft commodities. They produce some of the agricultural commodities such as soybeans. They've got corn. They've got coffee. They have their oil and everything else too. And you just see a lot of potential here. The dollar versus the real is kind of important for this. Dollar was weak to the real. That's good for EWZ. So a lot of stuff I'm seeing here gives me some more excitement for EWZ. The fact that it is testing previous highs. I mean, the 10.5 high was 44.02, but right now trading around 43.34. So there hasn't been much trade above this level. We've got bullishness in commodities. We've got money flowing into commodities. The dollar is weak relative to the real here. This was obviously off of that, a lot of the corruption issues. And if corruption issues come up again, Brazil's going to gap down. So I want to make sure that I do this with defined risk as well as the leverage. So I want that breakout potential here after I've seen this triangle forming. You can see it pretty clearly there. That's going to give me my leverage, and then my defined risk is because of things like this. Corruption scandals can come up anytime in Brazil. They're kind of a sketchy country with the way their politics are run. If I look to the option market, similarly, to the other stuff that I'm highlighting, the vol's low. I mean, vol's low across the board, obviously, but in Brazil, it's also very low here. Previous issues like corruption scandals and things spike the vol, but we're talking about 24% vol here, maybe a little lower. It just doesn't get much cheaper than that for the Brazilian ETF. The way I am looking at playing this is, again, because there's been a little bit of trade above. I don't necessarily want to go to October 20th. I want to give myself a little bit of time. Looks like somebody may have been trying to buy some calls, though, for next week. Scale down buyer, 17, 18, 15. So they've got a little bit more excitement off of these October 44 calls. But they should be a little bit cheaper on Monday morning as long as we're trading right here. If we're trading a little bit higher, it's going to just give me a little bit more time. If I go into the 27th, I like to look for $30 or a little bit lower on the calls. In this case, I'm looking at the 44.5s. These are around 27-ish cents. I think that's a good way to play this for me. 22 vol versus the October 20th stuff that they were buying. Somebody else was buying. It was a little under 22 vol, but it's very much more theta intense. I want to give myself a little more time for some of these ideas to play out because some of these ideas have been a little bit choppy right now with that overall market. So that means that sometimes when the overall market's chopping, I don't get an explosion higher in a sector. It's a little bit of a grind at first. So if I'm looking for a little bit of a grind at first, I want to have a little more time to expiration, a little less theta, and a little more, a little more time to expiration so that grind higher can work out. So that's what I'm looking at in EWZ is those October 44.5s. A lot of the stuff I'm talking about is off of that bullish commodity flow. So that gave me both EWZ and XME and GDXJ. And long TLT. I mean, all of this is correlated, you guys can see, right? For me, the play right now is this turnover in the dollar. If I look at DXY as one more just indicator on that, this is the dollar index overall, so it's not just Brazil. This is everything. It was flat on Friday. Maybe it bounces a little bit here before the next leg lower, but if dollar yen's going to be weak, if dollar real is going to be a little bit weak, then I think that those are bigger indicators of things to come potentially for bullish commodities overall. And bullish commodities have been kind of a theme all week for the gold trade because of this weak dollar index. Maybe it's time now to start thinking about what the impact is on things like oil and everything else, and then that flows through to the ideas I'm talking about now and the ideas that I'm focusing on for myself now. The last trade I have is XLF. Thought last week maybe the financials would really have a nice blowout move to the upside, particularly in the regional banks. That was reliant on a stronger dollar yen and some stronger yields, and they're not coming through. And all of a sudden, we're looking at financials, and some of the earnings are coming out, and they're coming out bad. So we've got bad earnings, a rollover in dollar yen, yields dropping. All of this points to some negativity to me for the financials. So I like the idea of a financial starting to get some pullback. There's a little potential for a move maybe down here to this last little consolidation area. So there was a gap there. So I'm thinking maybe around 25.5 is our first stopping point. It tested the 20-day and bounced really well on Friday. I don't think that's going to hold, though, if the dollar continues weak against the yen and yields continue to fall on the treasuries. And again, with some generally weak bank earnings, that gives me some minor excitement for a move back here down below 25.5. Trading that, I actually think that the thing for me is looking into this November 3rd again. I want to have non-farm payrolls and I want to have some Vega because I expect vol to increase when that happens, if and when that happens. You can see that vol right now is around 13.5%. Those puts I'm looking at around 15%. If we really start to break, the market probably pushes volatility up closer to 17%. We look at a year. That's a bad data point. But, if we look at a year, the highest vol really gets is, 18, 19%. So I don't want to buy, these wing year puts that are already at 18 or 19%. I want something a little bit of probability that is well in the money on that move back towards 25.30. These are 20 cents in the money on the move to 25.30, and then there's going to be a little bit more extrinsic value as well if volatility increases on that move. So I like, again, giving myself a little bit of time, since dollar yen may find support there at the 200-day moving average and negate this whole thing. But as long as that continues weak against the 200-day moving average and yields continue weak, I think that financials are the sort of final way for me to express that view, and that's going to be through buying some puts in the November 3rd 25.5s. So yeah, again, to wrap up on this, like this is really the key for me, and I'm going to be watching this all week. Dollar yen. This can't hold the 200-day moving average and starts pressing through some of these other moving averages and presses back to lows. It's going to be very bullish gold and very bullish miners and very bullish TLT and very bearish for financials and potentially really bullish for other commodity plays. So this is going to be my main focus, and I find a number of ways to trade it with vol low. Yeah, and then to recap again on the indices, because this is the other important thing. I still think that overall we're going sector rotation, and my sector that I'm thinking is going to be rotated into is obviously commodity plays, and out of other small cap plays. Biotechs have been a little bit weak. Maybe that's a problem area, and for those of you that have been watching, retail had a really bad week last week. So there's sector rotation, even though these markets are relatively stable. Financials can get some flow out, commodities can get some flow in if yields continue to fall. Reminder for everybody, I do this video for free for everybody. I'm going to continue doing this video for free, but I have more that I do as a premium product. I write up a newsletter. It's got usually 10 or 11 ideas, including the ones that I put on the video. So it's basically doubling that. It's getting more nuanced. It's getting more interesting setups that I like in terms of more complicated option structures, because I've been trading options for greater than 10 years. I've traded for a CTA and everything else, and constructing more interesting option trades is important to me. It's something that I can do well, and I can get some better relative value and better leverage out of them. So that's been my focus in this Harwood Report. That's in the premium stuff. I also do a midweek update because markets changed during the week. Last week, the dollar yen clearly changed on Wednesday from what I was thinking on Sunday. It needed to be reviewed, discussed, and sort of opened up that realization that maybe there was nothing there. So I had to go to a more neutral stance midweek as opposed to every Sunday. I mean, markets change day to day, not week to week. I also talked through why I pick some of these option structures for obvious reasons, and some of these call calendars and things like that. If you sign up now, I'll give you the first month for free. That extends to the first 100 subscribers. So there's no real risk for you. You take a month. If you don't like what you're getting, cancel it. If you like it, stay on it. $49 a month. And given the amount of work and content in here, that's too cheap. But I'll keep it here at $49 a month to try to get some interest out there, and eventually I'll probably end up having to raise that to match really with the content that I'm putting out there. So it's going to be free for a month, and then $49 after that, and eventually for future subscribers, they're going to probably end up paying more because, frankly, I've seen other newsletters and they charge more for less. So I think that this is a really good value, and if you guys don't like what I do and it doesn't fit with what you are looking to get information out of in the markets, again, you're getting a free trial. So go to tradeacademy.co/Harwood Report, take a look. That's where I'm going to have this video posted as well. And I look forward to talking to you guys, and hopefully, a few of you decide to join the service and, email me with questions, comments, etc. And speaking of that, that's how you can contact me. My email is tradeacademy.co. My email is keith@tradeacademy.co. Feel free to email me. Call me 312-600-8004 with questions or comments. And finally, follow me on Twitter @tradeacademy.co. I do some other updates on there of what I'm looking at and how I'm looking to express some of the views that I'm starting to see in the markets. So hope you all enjoyed today's Harwood Report, and we'll hopefully see some of you in the newsletter tonight. And if not, I'll talk to you guys for free next week.